So let's talk about the most important part. What is investment? By definition, investment is something which brings us regular income or will increase value in the future. And here there are images of three most popular investment assets we talk about a lot. It's the stock market, real estate, and gold. And all these assets we are going to discuss in this course. We will focus on the stock market, but we will talk about real estate and we will talk about alternative assets as well. But let's go a little bit back of investing and let's actually think that investment is not something new. We might not be taught about it and our parents might not have been doing it, but investment which exists for a really long time. Here there is a very old image about one of the first investments, and this is financing merchant ships. So in the past, rich people, they gave their money to a merchant to go with a ship somewhere to the colonies to buy their goods which were needed, to bring them and to sell them. If they were successful, they would receive part of the profits. If they were unlucky, the ship would sink or it would be robbed. There are many things could have happened to it. But that's in a very remote past. Not so remote past. 19th century, many of us probably saw Westminster Abbey. Well, the cook there invests in a real estate property. Now she rents a property to have an income. The family, they invest and they make an unfortunate investment on the stock market. So it exists for more than 100 years. And real estate investment and the stock market is something which existed for pretty long time already. Principle behind investing. And that's, I want you to start thinking about why people invest. What is investment? Well, investors, they have too much money. They have excess of liquidity of money, and businesses need money to grow. So every time actually we invest in something, we give our money to a business which potentially can earn money and can grow. And our investments helps this business to grow. Bonds and shares are two key types of investment assets. And these are only two things you have to understand. And if you don't have business education, these are two things you have to learn about. The rest is really not so complicated. So if you never heard about bonds and shares, I will share more educational videos about it. But let me explain you the principles and the main things about bonds and shares which will make sense. Bonds and shares. And in a moment you will understand why. Bonds. The principle behind any bond is that we lend the money and we will get our money back. So there is actually a contract which stipulates the period and when we receive our money back, after which period, and the interest rate which will be paid to us on a yearly basis. So a bond usually is structured this way. We know we will receive money, we know how long time it takes, and we know which interest rate this bond is paid on a yearly basis. It is a money lending instrument. So we lend money. It's also called fixed income. It's called fixed income because the interest rate is fixed in advance. It's the same every year. That's why it's called fixed income. So if we read financial news, we will see this phrase. And so we now understand that they refer to bonds. In Spanish, it would be renta fija. Bonds are considered more secure, risk of any bond depends on the issuing party. So it depends to whom you lend your money. So if you lend to a company, there is a difference between a company as Apple, which actually also could issue bonds, or a real estate agent which is building a new building. So there are lots of real estate bonds. When a company collects money, issues bonds, collects money to build a building, and then at the end of the period when the building is ready, when the apartments are sold, you are supposed to receive your money. So there is a big difference between a bond and the risk which is associated with it. Also, we see and we hear mainly about bonds issued by governments. And again, the risk will depend on the type of government we are dealing with. There will be difference between a German government or Argentinian government. So bonds are this kind of financial assets. Government bonds, they used to give attractive returns. They don't give attractive returns at this point of time, but they are considered rather safe. And everyone is advised to have this kind of financial assets in their portfolio. And if you have any pension plans, then for sure you have lots of bonds in your pension plans, because this is a safe way to have money there. Again, very low returns, but potentially also not so much decrease in value. Stocks. Well, with the stocks, the situation is different. We give money to a business in return for a share in a company. We become owners of that company. Even if we buy one stock, we are considered a shareholder or a small owner of the company, a small co-owner of the company. So nothing is guaranteed. We are not expected, nobody is expecting to pay us back our money. We became the owner. So we will have our share of the good and of the bad. So this is a big difference. Stocks are called equity. So when we read the news, when we hear the word equities and what is happening with equities, well, this is when they talk actually about stocks. In Spanish, it would be renta variable. Two investment assets, bonds and stocks, very different. According to official theory, according to what is written in books, everyone should have stocks and bonds in their portfolio. Depending on what is your risk profile, you should have more stocks or more bonds. There is a very popular ratio which is related with our age. The ratio usually is like this. If I have a portfolio of 100 and today I'm 45 years old, so then I should have 45% of my portfolio of my money in bonds and the rest should be in stocks. As I get older, I should get more bonds related to my age. So if I'm 60, then 60% of my money should be in bonds. If I'm 70, then 70% of my money should be in bonds. That way, I have a more secure portfolio which moves with my age. So if you're buying any investment products, if you're talking to financial advisors, when they start asking you for your risk profile, when they give you different questions, trying to understand how risk averse you are, what they are going to do, depending on how risk averse you are, they will give you more bonds in your portfolio. And that you have to understand. And today, bonds don't really give many returns. So what could have happened in the past? That you bought some mutual funds, that you made some investments through the bank. where you said that you are a conservative person and you don't want your money to fluctuate a lot. You are afraid to lose. So basically, you were given portfolio with lots of bonds, and these assets in the past 20 years were given very, very low returns. So you could have noticed that your invested money were not moving at all, were not growing, or actually decreased in value. Well, that is very much possible because since bonds are not really giving lots of returns, but financial institutions are still taking their cut of management fees, then it is possible that your portfolio actually performed very poorly, though being unofficially a very secure portfolio. Other investment assets which are considered alternative assets would be real estate and precious metals, art, or investing in startups. So when we talk about investing in real estate, we are not talking about the house you live in, because if you live in it, it's not giving you any income. Yeah, so this is owning a property, but which doesn't give you any income. So it's not really an investment asset per se. We will discuss more of it in the chapter about real estate. As a beginning investor, you shouldn't look at any alternative investments before you have your stable investment portfolio and before you purchase any assets as stocks and bonds. Yeah, so no crypto to start with. Actually, as you can see, crypto is still not even an official investment asset at all. So hold a little bit on buying crypto before you finish the course and understand the basics of investing and building your long-term portfolio.